In this video, I'm going to go over types of investments. I'm going to describe the characteristics of common investments and compare and contrast the risks and rewards. A savings account is insured by the FDIC up to $250,000 per account. The interest rate is relatively low, but the advantages are that an account can be opened with very little money and you can withdraw your money at any time. A certificate of deposit pays a fixed interest rate. Money must remain in the account for a specific period of time. They are also insured by the FDIC. It's very common that you have to have a minimum deposit of at least $500. And if you want access to your money early, you'd have to pay a penalty. U.S. government securities are issued by the United States government, and they include bonds, bills, and notes. They're basically a loan to the federal government, and the loan is paid back with interest. You can sell the securities before maturity, but there might be a penalty that you'd have to pay. Money market mutual funds are sold by investment companies. The money's pooled from different investors to purchase highly liquid short-term financial products. Treasury bills and certificates of deposits are examples of securities that would be included in a money market fund. Money market funds are not insured by the federal government. They're considered low risk. Their interest rates are higher than rates on a regular bank account. You have access to your money at every time, and some funds allow a limited amount of checks or payments that can be written against the account. Corporate bonds are issued by companies as a way for the company to raise money for growth and expansion. Maturity dates are usually 1 year. The interest rate is stated. Essentially, just like a government bond, you're loaning money to the company. The interest rate that's paid is tied to the value of the company. Stocks represent shares of ownership in a corporation. The value of the stock may be volatile over time, especially in the short term. The value is a function of demand and supply for the stock. And some stocks may make quarterly payments called dividends to investors. Stock market mutual funds are offered by investment companies that pool funds from investors to purchase a variety of stocks. The big advantage is diversification, and the risk of the fund depends on what the fund is investing in. So a fund that is investing in blue chip stocks would be relatively low risk because blue chip stocks are stocks of large, well-established companies. In contrast, speculative stocks are high-risk stocks in new, emerging, or financially insecure companies or industries.